Hello, hello everyone. Welcome to our bi-weekly seminar series. Today we have a very exciting paper by Peter Dixon, or rather presentation by Peter Dixon, who's proposing a new informed trading metric that sounds exciting. Peter asked that we hold our questions until he makes two pauses at 15 minutes and at about 30 minutes. So let's give him that space. And just a quick reminder, we've posted a call for papers for the fall series with the deadline June 26, I think. So please send us your papers. As always, we would love to have an exciting fall program. Peter, thanks for joining us, and please take it away.
Thank you. And everyone can still hear me well?
Yeah.
Thank you. All right, I'm excited to have the opportunity to present this paper, Detecting Informed Trading Risks from Undercutting Activity in Loan Order Markets, which is not a particularly clever name, but we think it is a pretty descriptive name of what we're actually trying to do in this paper. I'm at the SEC, me and Q are at the SEC, and Yashar is at Chapman. Coming from the SEC, I have to read this disclaimer that is posted at the bottom, which is that the SEC disclaims responsibility for any private publication or statement of any SEC employee. This presentation is provided in my official capacity as an economist, but does not necessarily reflect the views of the commission, the commissioners, or other members of the staff. So basically, if you get mad at me for this paper, it's my fault, not the government's fault. So with that being said, let's dive in. So this paper is going to propose what we think is a novel measure of informed trading. And there we go. So informed trading is key to many aspects of economics and finance. It's a key to our asset pricing theories and our and liquidity. It's central to our current microstructure with this emphasis on segmentation. And there are hundreds, maybe thousands of papers out there that try to study informed trading in various ways. And empirically, to study informed trading, we need to measure it. But this has been really hard because informed traders do their very best to hide their trades. The existing measures have mostly taken, as far as we can tell, basically taken the approach of focusing on the informed trader and trying to identify patterns that correlate with the trades of the informed traders themselves. And kind of the most easily, the earliest and most prominent is the pin measures, which are effectively like an abnormal price impact type measure. But these measures have recently kind of fallen out of favor because they're really hard to distinguish from liquidity, from exogenous changes in liquidity. So other researchers have proposed other measures. Johnson and So have an MIA measure, which uses a theoretical link between options data, between options markets and equities markets to provide a measure of informed trading. But this measure has a drawback in that it requires options data, and so not all stocks have options data. And lastly, like the most recent one is this ITI measure, informed trading intensity, which is basically the authors take a subset of known informed trades, and then they use a machine learning algorithm to kind of say like, well, what's happening in the markets when these informed trades are happening, and can we create a measure based on that? But ITI has kind of two drawbacks, and that it's a machine learning algorithm without super clear economics explaining why the measure works, and it has potential look-ahead bias because it uses an informed trading sample of over a certain period and creates the parameters for a measure that they apply to everybody. So bottom line is these are great contributions, but it underscores how hard this has been. And I'm also going to point out that they all focus on the behavior of the informed trader. Now, we're taking a different approach in this paper, and we're going to try and focus on the behavior of the liquidity providers who interact with the informed traders. And so that's going to be kind of our big conceptual shift from these previous measures is we're specifically looking at the liquidity providers. Now, this is not all that new of an idea. I mean, informed trading, adverse selection is a major cost of liquidity providers. And for the past 40 years, we've been relying on models like Kyle and Gloss and Milgram that argue that the liquidity providers are going to change their behavior when they're faced with increased adverse selection. Like that's the whole idea of like lambda changes when adverse selection goes up. And so the idea here is the liquidity providers learn from market conditions and extract signals about when informed trading is high, and they adapt their behavior accordingly. So if we can measure, we can measure informed trading if we can identify a liquidity provider behavior that correlates with informed trading. And we think that we think that we've got one. And so we're going to argue that undercutting runs will diminish when informed trading is high, and that this can be easily detected in the data. And this insight allows us to create an informed trading metric that has very straightforward economics. It's easy to compute. It's adaptable, meaning you can easily compute it at multiple time horizons. And we'll show you some of our analysis where we use this measure at a 5-minute horizon and at a 1-day horizon. And we find that it's useful in both. It only requires top of book limit order data, e.g. TAC in the United States. And we're also going to show that in the tests that we run, it outperforms existing measures of informed trading. So what is an undercutting run? An undercutting run occurs when multiple liquidity providers compete to provide liquidity to an upcoming expected uninformed order. And these algorithms will submit successive single tick price improvements in order to get to the front of the queue. And the run stops when the trade arrives, or further improving the price would render the trade negative expected profit, or if the tick constraint binds. So in this kind of hypothetical example here, we have 3 one-sided price improvements followed by 1 trade-driven price deterioration, all on the bid side of the market without a whole lot going on the ask side of the market. So this is kind of what an undercutting run will look like. But when there's informed trading, when adverse selection is high, liquidity providers will compete less to provide liquidity. We may see fewer undercutting runs in general. Liquidity providers may simply bow out until conditions are more favorable, or runs will stop earlier because runs will stop when one more improvement would push the revenue below the marginal cost. So in this kind of hypothetical example, you see 2 improvements to 1 deterioration. And so we're going to argue that the prevalence of undercutting runs can be used to measure informed trading. Now, in early versions of the paper, we did not have a theory model, but we tried presenting this at a number of conferences, and we found that particularly people outside of core microstructure kind of got confused. And so we added the model, and microstructure people look at this model and they think that's so simple, why do you need the model? Non-microstructure people have told us they look at the model and they say, thank you, because it helps me understand what you're doing. So I'm going to run through this very simple model that kind of formalizes the intuition of what we're doing. So it's a 1 period Glosson and Milgram model. An asset takes an equally likely value of 0 or 1. High fraction of liquidity demanders are informed, and 1 minus pi are uninformed and are going to buy or sell with equal probability. We're going to have 2 different liquidity provider types. We're calling them sophisticated and unsophisticated. There are M sophisticated liquidity providers who pay a cost C, and with probability rho, they'll learn whether the next order to arrive is informed or not, and on which side of the market the trade will arrive. The probability that at least 1 sophisticated liquidity provider gets a signal is we're going to define as phi, which we just show there. And the unsophisticated liquidity providers are passive and competitive, and they're going to be the ones who set the prices equal to the expected value conditional on a trade arriving. The arrival time of trades is random, but is distributed exponential with parameter lambda. So it's a very simple setup. And this decision tree basically describes the model. So with probability phi, at least 1 SLP gets a signal. And then with probability 1 minus pi, the signal is that the trade is informed. Now, if the trade is uninformed. If the trade is uninformed and a signal arrives, at least 1 sophisticated liquidity provider gets a signal, then they'll start an undercutting run. The other sophisticated liquidity providers will see the undercutting run, and it'll trigger a run. So the probability of a run is going to be equal to phi times 1 minus pi. And so this is kind of our measure of run prevalence in the market. And you don't even have to do the derivative, but the derivative of the probability of a run with respect to the informed trading risk is just negative phi. the informed trading risk is pi. And so there's an inverse relationship between run prevalence and informed trading. Now, the model has a few other predictions. If you work it out, you can compute the equilibrium ask price and bid price and the spread, which gives you a few other predictions that we can actually take to the data and show some interesting things. One is that the spread is going to be increasing in the probability of a run, meaning, and this is simply because the probability of run is going to be related when there are more sophisticated liquidity providers eating up these uninformed trades. They leave fewer uninformed trades for the unsophisticated liquidity providers who actually set the bid and the ask price. And so it increases adverse selection when there's more. And we think this is interesting because there's previous research that kind of links undercutting runs to wider spreads, and we provided an explanation for why that could happen. The other thing you get in the model is that undercutters are going to only undercut by a single tick. And so we're just going to say that epsilon is the amount that you undercut. And so you can compute the expected profit for all of the undercutters, for all of the sophisticated liquidity providers. And it's simply the probability that you win the run, meaning it's your quote that interacts with the incoming trade, multiplied by the expected profit. Now, the expected profit is going to decrease with each step of the run. And so you can write the profit function here like this, which is, that's all it's saying. It's just the probability that the trade arrives in a given window multiplied by how much you would make in that window. And then the key thing here is epsilon, which is the improvement amount, is going to we already got a question in the chat about whether it works for tick constrained stocks, and the answer is yes, but I'll get to that quite a bit later. And I'll explain why we believe it works for tick constrained stocks. Is basically is expected profit is always decreasing in epsilon, so you will always undercut by the minimum amount. And this is, so the model is very simple, but it has a number of predictions. Undercutting is going to be inversely related to informed trading. Undercutting occurs in units of the minimum trading increment. Undercutting runs will stop when one more update will render the trade negative expected value. And at the end of the trade, prices will revert. And this is simply because the trade was uninformed, and so ULPs didn't learn anything. So once the sophisticated liquidity providers' quotes disappear, the price goes back. So what I'm going to show you now is something that's not in the paper. It's something that Yashar and I have been, and Qiyu and my co-authors and I have been working on. We have been incredibly fortunate to get a revise and resubmit at JF with this paper. And so this is something we've worked on as part of the revision. So in the next month or two, we will likely post a new version of the paper that has all this. But this is actually the first time we've shown any of this information or any of this stuff here, which is kind of cool. So first off, the question is, what do runs look like in real life? So what we're going to do is we're going to take the TAC data, and we're just going to look at each August. But basically, we're going to take from Words. Words has a full and complete NBBO, which just basically is the Holden and Jacobson edits to the NBBO. And then we're just going to kind of divide the data, the quote data, into the buy and sell side of the market. And we're going to identify series of single tick updates on one side of the market. We're going to merge in the trades, and then we're going to basically highlight the ones where there's a series of single tick updates followed immediately by a trade as the next thing that occurs in the data. And then we're going to compute the mean spread at each point in the run, and then the median time between each step in the run. Now, the reason why we use medians for the time between each step is because for most of these, it's pretty small, the time between each step, and so outliers can cause big issues. You get a couple of big outliers, and it makes everything look weird. So we're using median time between each step of the run and the mean spread. And remember, the predictions here are that spreads are going to narrow by about 1 tick per step, and spreads will narrow only up to a point. And this is exactly what we see when we look at the data. So we do this by multiple different spread levels. So we use the Words intraday indicators data to see, does a stock have a time-weighted average quoted spread below 2 cents on a particular day, meaning it spent some of the day tick constrained. 5 to 10 cents, and then greater than 15 cents. We have the other intermediate levels, but I just don't show them here because they all tell the same story. Is that even for stocks with very narrow spreads, you still see runs, and the runs occur. They tend to occur when the spreads happen to be a little bit wider. I'll talk more about that in a little bit. But for these stocks, and I think that a couple of things that were really actually fascinating to us as we really dug into this was that it didn't matter. We did it at different time horizons. We wanted to see if the early period was different from the later period, and different quoted spread groups. But what we found uniformly was that there seemed to be a level at which the run would shrink, or the spread would shrink up until a certain point at which it didn't. So you can see for these stocks that had spreads greater than 15 cents on that given day, that it doesn't matter the length of the run stopped when the spread hit around 16 cents, and it didn't really on average go much narrower than that. The other thing is, if you calculate the average reduction in the spread in each point, it's about 0.8. Now this is useful because there's kind of an alternative idea that perhaps markets are just moving to incorporate expected information, in which case you wouldn't necessarily expect to see spreads narrow, because these runs we're not, when we identify the run, we're not looking at the opposite side of the market. So the opposite side of the market could be moving in lockstep with the run, which would be consistent with kind of price updating. Or the opposite market could be, basically staying flat, which would be consistent with a run. And we find that there's not a whole lot going on the opposite side of the market during these runs, which is consistent with the spreads on average narrowing by about 0.8 cents each step of the run. And so how often are these runs? And so this is kind of what the runs look like in real life. And how often are the runs happening? So the first thing is we looked at was the average, or the number of run steps per day. Now the mean stock has around 200 run steps. Now a run step is like if a run is of length 9, it'll have 9 steps. If a run is of length 1, it has 1 step. But the number of run steps per day, the average is about 200, but there's definitely some right skewing, as you can see from the percentiles. But the median stock has about 60 to 70 run steps per day. And this is a pretty conservative lower bound, simply because when we're identifying the runs in this data, we throw out anything where there's a trade that happens in the middle of a run, and we have a number of other filters. And so because we wanted to try and get the cleanest measure possible that we could of these runs. And so this is going to be a conservative understatement of the prevalence of these things. But probably more relevant is the percent of NBBO changes that are part of runs. So if you just take the full and complete NBBO data, you can count the number of NBBO changes that occur in a day. You just divide that by the number of run steps that happen in a day, and you can calculate the fraction of NBBO changes that occur due to a change, what we're identifying as a run, which is a series of single tick updates followed by a trade. And for the median stock, it's about 6 to 7%. And so this gives us confidence that these runs are sufficiently general that we can create a measure that is usable across stocks. So now, how do we actually measure runs? All right, so we're going to introduce what's called the QID measure, QID measure, and we're calling it the quote improvement to deterioration ratio. Now, if we remember, like this run, we had 3 improvements and 1 deterioration in this run. And the more improvements to deteriorations, the greater the prevalence of runs is what we're arguing. So we're going to create this QID measure, which is the total number of NBBO improvements. And so we want this to be simple and easy to understand. And so it's just the total number of NBBO improvements in a particular stock on a day, although you can do other time horizons, minus trade-associated NBBO deteriorations. And we define those as deteriorations that occur within 10 milliseconds of a quote update. Quote deteriorations that occur within 10 milliseconds of a trade, and then just divided by the total. and so in the presence of undercutting runs, there will be more quote improvements than deteriorations. And so with more undercutting, quid will get closer to 1. And so this quid measure is a measure of undercut. We argue is a measure of undercutting prevalence. And we were actually, a little bit flattered. Terry Hendershot's forthcoming JFQA cites this and uses it as a measure of undercutting in that paper, which we thought was pretty cool. But before we can get from quid to a usable measure of informed trading, we have to ask a couple of questions. Run length is mechanically related to spread. So is quid just capturing liquidity, and are we just back in Pinbrook? And the answer is yes, quid and liquidity are really strongly correlated. So what we're going to do is we're going to modify quid to remove liquidity and then make it standardized so it's comparable across stocks. So the first step we're going to do is in a particular quarter, we're going to run a simple regression with quid on the left hand and spread on the right hand. And then we're going to save the coefficients from this regression. And then we're going to apply them to the daily observations in the following quarter. So it's like an out of sample test. And then we're going to standardize the whole thing by the standard deviation of quid in the previous quarter. And so we're calling this measure quid res, which is the residual quid or the quid ratio that is residual to liquidity. Key to this is we're going to multiply by -1 to make a positive measure of informed trading instead of a negative measure of informed trading. So when we use the quid in all of the tests going forward, we're going to multiply it by -1. This is my last slide before I pause for questions. And what we have here is, so how well does quid work? Right here, we plot the correlation coefficients between daily quid res and contemporaneous liquidity measures, and we find that they're basically 0 across the board. And so this very simple measure, this very simple procedure appears to have removed liquidity from, this is not a strong measure of liquidity on any dimension that we normally measure liquidity based on. Next is we're going to look at just simply the correlation coefficients between daily quid res and contemporaneous informed trading risk measures. And we find that they are also quite low, and which we kind of interpret as we have a different approach. All of these measures are focused on the behavior of the informed trader. We're focused on the behavior of the market maker. And so we think that our measure is actually capturing fundamentally different aspects of what's happening in informed trading than these other measures, which is why the correlation is so low. So I'm going to pause there. I know there were a couple of questions in the chat, and my colleague Yashar's on here too. And so together, we had one. How does it work for tick constrained stocks, which are about 50% of the total? Actually, I'll briefly answer that a little bit more now, but I've got actually a couple slides on this later about how does this work for tick constrained stocks. And the answer is it works fine. We redo some of our tests, limiting it to just very narrow spread stocks, and it still works great. Second is we believe, well, why does this work for tick constrained stocks? Well, tick constrained stocks don't always remain tick constrained throughout the entire day. There are time periods when they have wider spreads, and when there's less informed trading, we expect they will compete more to narrow the spread when they widen. Plus, there's the effect of rebates, which is that crossing the spread. So an undercutting run could cross the spread to execute a trade, and that doesn't always result in 0 profit due to the influence of rebates. And really, the measure works as long as there's any undercutting behavior, and because it's standardized, each stock is standardized to itself, and so so now I can skip those slides, but that's basically the answers. We think that we show that it works for stocks with very narrow spreads, and 2, we believe that it works because there's still undercutting type behavior due to rebates and due to the fact that spreads sometimes widen. Can you comment on what influences
Peter?
Yes.
In the interest of time, there's quite a lineup of people who want to ask a question with their hands raised. Maybe we could start with them, and then Yash, if you have an opportunity to answer questions in the chat, we could do it that way. Bjorn?
That would be great. Yeah, if you have a question in the chat, Yashar, would you be willing to try and take those, and then I'll do that. So let's start with my top left, which is Bjorn.
Yeah, very interesting. I saw in your plot of the undercutting runs that on the x-axis you had several seconds. I was surprised about that, thinking about these market makers as high-frequency traders. Seems more like undercutting walks than runs.
I think that's a good. I think that's a good point. So the way that we have thought about this is, in the model, like the arrival time of the run of the trade is not certain, and so if you instantly undercut as fast as you possibly could, basically the spread would go to this minimal level instantly, and that wouldn't be profit optimizing for anybody. And so if you haven't guessed that, like, you get a signal. And I've actually talked to market participants and read a number of like Battlefish and a handful of other data analytics companies keep blogs about like how they actually predict trades in the markets. And if you read these, like, they get a signal, but these signals are always imprecise, although they can be, decently good. And the thing is, if you don't know exactly when the trade's going to arrive, it seems to me that the arrival time is likely to be, they get a signal, okay, sometime in the next 5 to 10 seconds, a trade's going to arrive. So they start undercutting, but you don't immediately, because I guess if you think about it, the idea is you want to try and get your trade, your undercutting right before the trade arrives. And so if everyone immediately did it, it would go to zero profit pretty much instantly. And that's kind of how we interpret these undercutting walks. I like how you call it undercutting walks, because like we were actually, Yashar and I, when we really took a look at this, we thought that was a really interesting thing first. Does that answer your question?
Yeah, thanks.
All right. I'm sorry if I don't pronounce it right. Faisal?
Faisal.
Faisal. Okay.
Can you hear me? Yeah.
I can hear you.
No, so my question is, yes, my question was that if you, in the data, do you see this runs more after extreme price moves? Because you would think that after some extreme price moves, then you would have market makers that are basically scrambling to adjust their positions to get rid of inventory. So in that sense, this undercutting would be motivated by inventory management rather than informed trading. Thank you. And yeah.
No, that's a great question. And if you can, we have like 4 slides on the relationship between undercutting and inventory risk. And I think I'm willing to stay after. If I haven't answered your question when I get through those slides, I'm happy to stay on. The bottom line is, the short answer is we did a lot of looking into the relationship between quid res and inventory risk, and we find that inventory risk doesn't seem to provide much of an explanation for what we find. But I'll show you exactly what we do on that in a little bit. So PK.
Yeah, thank you, Peter. So very interesting paper. My question is similar to Faisal's. I mean, is this really informed trading, or is it simply aggressive trading, right? And aggressive trading could be for other reasons too, not just inventory management. People may be counting on reversals and so on, because you're not finding any correlation with informed trading measures, right? So maybe it is just simply a measure of aggressive trading.
So I think that's a great point. Let me walk you through a lot of the tests that we do to kind of, we try to do our very best to kind of take some of these questions out and say, is this actually informed trading, or is it capturing price reversals? Is it capturing a number of things? So let me walk through the actual test that we do, and if you still have questions, I'm happy to stay on as long as we need to discuss. So Andre, do you have a question?
Yeah, Peter, a quick clarification. I think at some point you mentioned that on average there are 70 run steps. Did I hear that right? And
yeah.
And if so, does that mean 70 cents?
Yes.
Tick size, because of the tick size?
Yes. Yes. So the runs over the course of a day, runs will narrow the spread by 70 cents per step, or per step, but they revert at the end of the trade, and so they're not going to keep the spread. They're not going to narrow the spread or push the price up or down. You see spread narrows, goes back, narrows, goes back. And so over the course of the day, these run steps are, you will see about 70 cents of price improvement, I guess you could say, due to these runs over the course of a day.
Okay. And how about the one simple run? How many steps in that?
Like what's the average run?
Mm-hmm.
So the average run is going to be very strongly related to the average spread. And so for these stocks with 2-cent spreads, the average run has 1 step in it. But for the stocks with like 5 to 10 cent spreads, I think the average run was something along the lines of like 4 cents was the average run. And it just, so the average run length is going to be often, or I guess for the median stock rate, correlated with the spread at the time.
Okay, thank you.
Yeah, Michael?
Yeah, so I was just curious, the stocks that experience the most run steps in a day, is that stocks that just aren't as tick constrained, or is it stocks that might be more tick constrained but just have more trading interest in them? Given that the more tick constrained stocks don't really have as much room for a longer run. So I was just curious if you could comment like the characteristics of the more run experiencing stocks.
Yeah, no, that's a great question. So which stocks tend to have, I guess it's a great question. It's not one that we have focused on super strongly, simply because the QuidRes measure standardizes the measure to the stock. And so stock-based correlations aren't as critical to it as an informed trading measure, but in terms of understanding the mechanics of runs themselves, I think it's a really interesting question. And the answer is it's going to be a mixture of all these things. Like stocks with higher trading volume are going to likely have more runs. Stocks with wider spreads are likely to have more runs. Stocks with just like a lot of less informed trading. And so it's going to be a mixture of all these things. I think Yashar and I could take a look at it. We could probably throw an extra table or two of descriptive statistics up here that could answer a number of these questions. But that's kind of what I got for you there.
Thank you.
Okay, let's keep moving forward. All right, let's go back to where we were. Okay, so now we're going to use this. We're going to look at QUID as a measure of informed trading. So the first thing we're going to do is we're going to look at how does QUID predict information events. And we're going to focus on unscheduled press releases, and we're going to focus on earnings announcements, 2 periods that are known to be associated with informed trading. And so the first thing we're going to do is we're going to be comparing QUID to these kind of standard measures of informed trading, ITI and PIN and the MIA-based measures. And we're going to look at, so this first graph right here shows that ITI and PIN and MIA, although for press releases, MIA doesn't seem to work very well, but you basically get a spike in informed trading based on all these measures, which is just consistent with, you can't get an informed trading metric published unless you run a number of tests like this. And so this is kind of connecting us with the previous literature showing that we have replicated with these other measures kind of some of the existing results. And that informed trading tends to spike around earnings announcements, and it tends to also spike around unscheduled press releases. So now here's what we're going to show. This is what the QuidRes measure looks like. And so the dark line is QuidRes, the left is unscheduled press releases, and the right is earnings announcement. In the background, in kind of the light gray, we posted the bid-ask spread, because spreads also are known to widen around these time periods. And we think this is interesting because, as we saw previously, the correlation between QuidRes and bid-ask spreads was effectively 0, except in periods when there's high amounts of informed trading. And so we see that QuidRes does a good job predicting informed trading. It shows a spike consistent with what we know about informed trading right around these earnings announcements. So now we're going to push this a little further. We want to see and so this is a test that we believe is new. So what we're going to do is we're going to look at earnings forecast dispersion. And the idea here is that when there's a wide range of opinions about what earnings forecasts are likely to be, that's a setting where you would expect to see more informed trading, that's a setting where you expect to see more informed, more opportunities for informed trading, because there's so much. If everybody kind of agrees, this is what the earnings announcement is going to be, there's maybe less opportunities for informed trading. So what we're going to do is we're basically going to look at just the differential between the highest quintile dispersion and everybody else in terms of how much informed trading we see around these earnings announcements. And what we find is that Quid is the only one that shows a spike in informed trading in the highest dispersion stocks than relative to the other stocks that have lower dispersion. And so QuidRes, which is this top left one, shows that there's a, and this is like the difference in difference idea. And so this is the differential level of informed trading. We know that informed trading spikes around these earnings announcements, but it spikes additionally more if there's a lot of dispersion as measured by QuidRes, whereas none of the other informed trading measures capture that, which we think is one way that we demonstrate what we feel is the kind of the superior performance of QuidRes relative to some of these other measures. The other test that we're going to look at is we're going to look at spillovers. So this one's kind of cool. So when there's an unscheduled press release, our previous slide study showed that, yes, there's a clear spike in informed trading based, all the measures kind of showed there's a clear spike in informed trading. What we're going to look at is we're going to look at other stocks with the same four-digit SIC code. And we're going to say, were there spillovers and was there more informed trading in these other stocks at the same time as this or leading up to this unscheduled press release? And the graphs here are not as, they're a little bit harder to interpret, but let me explain what basically you've got here. The red line marks the lower bar of the confidence interval on the day after the press release. And then basically, if we go to the left of that, we want to see, is there a time, do we see a statistically significant increase in informed trading prior to the press release? And so basically, if you see the confidence bars to the left of the date fall below that red line, then it suggests that you're seeing a statistically significant change in informed trading. And what we find is, I don't know if you can see my mouse, but like right here, we see that QuidRes does show that informed trading, that there does seem to be some spillovers. Informed trading is statistically lower in the days prior to the announcement relative to the day right after or the day of the announcement. ITI, you see a similar pattern, but it's not statistically significant. MIA does seem to predict this same pattern, and PIN just shows absolutely nothing. And so what we think the way we interpret this is Quid seems to do a better job. It's the only one that passes both of these tests. It passes, or I guess passes all four of these, meaning it shows increased informed trading around press releases, earnings announcements, this dispersion effect. It's the only one that captures the dispersion effect, and it and MIA are the only ones that seem to capture the spillovers. Okay, so the next we're going to do is we're going to see, does it predict unscheduled press releases and news announcements? So the dependent variable is going to be just a 1 or a 0 for whether or not there was an unscheduled press release on a given day. And then we're going to control, and then we're going to just see, does QuidRes, and we have a bunch of controls, but we're going to see, does QuidRes predict the arrival of these press releases? And so basically, do we see a positive correlation, a positive coefficient on QuidRes and statistically significant? And we do. And the cool thing is we run these regressions every single year, because we also want to see, like, does this measure work throughout time? And every single year it is positive and statistically significant, suggesting that QuidRes does predict the arrival of unscheduled press releases, which is consistent with informed trading. Okay, so the next thing we want to look at is does it have incremental ability to predict unscheduled press releases? So it's the same basic logit setup. But what we're also going to do is we're going to control for PIN and MIA. We don't include ITI because ITI has look-ahead bias issues here in this context. And so we didn't feel like it was an appropriate measure to use in this sort of setting. But we just include PIN and MIA, and we show that QuidRes continues to positively predict future returns even after controlling for other measures. So it does have incremental ability above these other informed trading measures to predict the arrival of unscheduled press releases. Okay, we're going to show you that next. We're going to show you that it associates with the behavior of informed traders. And so this one's a cool one. This is one now is where we get to using it at a different time horizon. So between 2011 and 13, a group of Russian and Ukrainian hackers did what hackers do, and they hacked a newswire that companies used to release earnings announcement, which gave them insight. The SEC prosecuted these hackers, and the trade times, the exact trade times for their trades, were obtained from court documents. And Gregoire and Martineau have a 2022 JFE that looks all at this. And so the question is QuidRes associated with these known informed trades? So in the instance of time, we compute 5-minute QuidRes. So we do it at a 5-minute basis instead of a daily basis. And then we see intraday, does QuidRes seem to appear to go up around these known informed trades? Now, I'm going to be totally honest. These 3 examples here were picked because they look really good. And they show that, you know, when informed trading starts, QuidRes seems to go up on an intraday level. Now, to be a little more specific or scientific about this, we basically we do the day of the informed trade, and then 1 week prior, we divide each day into 5-minute trading 5-minute segments. And then we just run a simple fixed effects regression to see if the intercept for the level of quid goes up or down on in the specific 5-minute increments when the informed trades arrived. And what we find is that the control and the others don't statistically differ from each other. So that the other is the day of the informed trade, but not a 5-minute window when informed trading was happening. And we don't find a statistically significant difference there, but within the 5-minute windows where the informed trades hit the market, we see a spike, a significant increase in average QuidRes, which we think is cool because it shows how easy it is to use this measure, that way. So I'm going to skip some of this because we have 3 minutes left. But QuidRes, we show that it's correlated with so Yashar has a JFQA that creates a sample of really informed trades, and we show that QuidRes is powerfully associated with these kind of known informed trades. We look at short selling, changes in short interest, which are known to contain information. And we see that when changes in short interest are either high or low, you get the smile. And so quid tends to be higher when changes in short interest are high or low, which is consistent with it capturing the behavior of informed traders. Okay, so this is getting to the inventory risk. I know I have 2 minutes, and I will do this then. But basically, the idea is when inventory risk is high, market makers may be leery of taking additional inventory, so they may undercut less, leading to an endogenous relationship between inventory risk and QuidRes that could affect inference. And so we're going to first off, we're going to address this by simply, we're calling it QuidRes IOV. And so there's this recent JF that creates a measure of inventory risk. And so we're just going to take that, like equation 1 that I showed you previously, where we orthogonalize quid to the bid-ask spread. And we're also going to orthogonalize it to the measure of this inventory risk. And basically, if inventory risk is messing up quid, we should see quid works a lot better once we add this additional layer of controls. And we don't. It works basically the same. And so that's the first way we kind of get at, like, is this inventory risk? So QuidRes IOV around these things, it works. It does basically the exact same thing. The next thing we're going to look at is price reversals. So price reversals are associated with inventory risk. And so if QuidRes is strongly associated with inventory risk, then reversals should be stronger on days with high QuidRes. Now, basically, I don't have time to explain the whole setup, but basically, the way we've set this test up, if that's true, then the red boxes should have negative statistically significant coefficients. They don't. They have positive statistically significant coefficients. And which is not consistent, or which is inconsistent with kind of the inventory risk story. So bottom line is we don't think the inventory risk is driving our is driving our measure. Lastly, we're going to look at quote price discovery. So the idea here is if quotes are moving up to anticipate trades. So like, let's say there's a bunch of quote improvements on both sides of the market, and then there's a trade, you would see 3 improvements and 0 deteriorations. And so you would get a quid of 1 in this because of the 0 deteriorations. If you just calculate quid on the bid side of the market, you know what? All right, I'm gonna have to pause. This is a fascinating thing, but it'll probably take me 5 to 10 minutes to explain it. But basically, in
Peter,
the upcoming version of the paper, yes.
There is really no rush. So if you want to take 5 minutes, please do.
Okay. I see it's 11:45, which is when we're supposed to stop. But if people are willing to hang with me for a couple minutes, this is a really cool, what we think is a really cool analysis that we've done. Okay. So an alternate story could be that quid could be capturing informed trading via quote price discovery rather than via undercutting mechanism. Now, quote price discovery, in that case, the bid and the ask will look kind of like this. There will be an informed trader, and this is in this idea, there's in kind of a low informed trading market. So informed traders, they would obviously like to execute their trades via limit orders, and so they'll update the price on one side of the market to try and get their informed trades in, and then they'll update it again until they can get their trade executed. In this case, this is like the low informed trading setting that we're talking about. In a high informed trading setting, they just have to give up on trying to execute it via market order if their information is really valuable or really potent. And there's research that shows that they switch from liquidity providing orders to liquidity demanding orders when their information is particularly potent. So the idea here is that in a low informed trading setting, you would see a number of quote improvements. So on the bid, you're seeing quote improvements. On the ask, you're seeing quote deteriorations. But on the bid, you're seeing quote improvements followed by a trade. And in this case, you would see 3 quote improvements followed with 0 trade-driven deteriorations, which would give you a quid level of 1. If we just computed quid on the bid side of the market, you would also get, we're calling it B quid. So it's ignoring the ask. You'd also get a measure of 1, a B quid of 1, and the average spread would be constant. Now, if it's a high informed trading setting, you're going to see the trade, they're going to switch to the opposite side of the market, and they're going to demand liquidity. And so you might see some quote updates, and then on the bid, so some quote improvements on the bid, and then a quote deterioration on the ask. And then this would end up giving you 3 improvements and 1 deterioration, which would give you a quid of 1/2, or a B quid of, which would give you a quid of 1/2. So the idea is if information moves from being kind of less salient to more salient, you could see a decreasing quid mechanically through this quote price improvement story, and which could explain it wouldn't change the validity of the measure, but it would change the mechanism. And so this is something that a number of people, including our referees, have asked us to really look into, and so we think there's a couple of ways to differentiate between whether or not our measure is capturing undercutting or quote price improvement. And the first one is if quote price improvement is the mechanism here, then quid will work just the way it does. But if we only compute quid on one side of the market, so just throw away all of the trades on the ask side of the market and compute B quid, you can see here in the low informed trading, B quid is going to equal to 1. And in the high informed trading, B quid also equals to 1. And so if we compute quid with just trades on one side of the market, then it shouldn't work. If quote price discovery is what's driving our results, then and actually I put these slides in here because also it doesn't really matter. I mean, B quid does not change. Like in the high informed trading, if there's only 1 step or 2 steps or no steps, the B quid is always going to be 1. And so even though the quid measure is going to change. So what we're going to do is we are going to replicate our what we call like our big differentiating tests And we're going to do it with just A quid and just B quid, meaning we're going to compute quid just using quotes on one side of the market. And if quote price discovery is the primary thing that's driving our if quote price discovery is the primary thing that's driving our result, then A quid and B quid should fall apart. Now, and that's not what we find. We find that A quid and B quid both work just fine as measures of informed trading. And actually, in the version of the paper, we go a lot more sophisticated in here. We actually we build out the kind of the theory of it, and then we have some derivatives that show that it doesn't work, and then we have these tests. But the bottom line is we believe that a powerful test that distinguishes between quote price discovery and undercutting as the mechanism behind the results is this asymmetry that we see here. And so this suggests, the other thing is when we look at undercutting runs, our units of, actually, well, I'm going to skip this. I'm going to skip that too. So bottom line, undercutting or quote price discovery, we can't rule out quote price discovery as playing a role in establishing the link between our quid res measure and informed trading, but it appears to be a secondary role. And so tick constraint stocks, I already answered that. Here's the results when we show some of our key tests with conditioning on spread. It appears to work for tick constraint stocks, and we believe it works for kind of the reasons that I mentioned. I'm going to skip the fragmentation stuff. So what have we got? A simple intuitive measure of informed trading that does not require structural models, machine learning, prop data, or options data, can be computed for any asset with limit order data. It's uncorrelated with existing informed trading measures, liquidity, and a host of other variables. It predicts the arrival of significant news events, can be computed at a daily level. And I didn't do any of the asset pricing stuff because that's not core. So thank you for letting me take an additional 7 minutes. I'm happy to stay on as long as people want to stay and talk.
Thanks, Peter. This was a fun sprint of an ending.
Yeah, I appreciate that. Sorry, I felt a little scattered and rushed, but
I thought it was good. Folks, as always, raise your hands and ask your questions. Faisal?
Oh, thank you. I can go first. So my question would be that it feels, maybe I'm wrong, but that the quid primarily captures the moments when information is actually traded a bit aggressively, or when information is currently being digested by the market. And because I'm thinking, if a trader holds some very private information that is not public, wouldn't it be rational for them to trade, in fact, during the undercutting? In the direction that favors them, right? Because that would improve maybe their spread. And yeah, thank you for the talk, by the way.
Yeah, so that seems to me to be kind of another way of stating like the quote price discovery question that we were just discussing, that like, of course informed traders are going to do their very best to and I guess this is maybe why we say informed trading risk. Like if to the extent that an informed trader is trading with liquidity providing orders, like I guess, yeah, this is why we say like, yeah, we can't completely rule out this as a potential alternative, because as a potential contributing factor to why our measure seems to capture informed trading. But it just because you're right, they're going to try and trade with limit order markets. We like to see this shift in behavior, which could create this mechanical relationship between, not mechanical, but this relationship between changes in quid res, and informed trading. And so I think, yeah, we can't fully rule that out, but I think we feel like it plays a secondary role.
So Peter, if I may, so
yeah,
if it is informed investors that are actually driving the undercutting, we should see more undercutting associated with higher informed trading, and that's the exact opposite of what we see in the data. So where we know informed trade happens, we see abnormally lower undercutting. We are not able to rule out entirely that there are cases where undercutting is driven by informed traders undercutting others, but that's more likely to happen in low information states, or sorry, low value information states. If the value of information is particularly high, it is shown by theory and empirics that they probably switch to consume liquidity. Sorry.
Thanks. All right, Josh.
Yeah, thanks for the talk. I was just wondering if you could talk me through one more time the intuition for why in the model when undercutting happens, it's just by one increment at a time. Because I kind of would have thought, well, if I undercut, I realize that somebody else is going to undercut me. There's going to be a run. I know where this run is going to end. It's going to be where one more undercut would lead to negative profits. So why don't I just go directly there?
Right.
I think I missed that piece.
Yeah, no. So the intuition there is that the least profitable outcome is when the price goes to the very end. Now, like in the model, the trade arrives. In the model, the arrival time of the trade is random, and so it could arrive at any point. It could at any point, and so obviously the most profitable, if you're the first one to undercut and then the trade arrives, you make the most amount of money. And with each undercutting step, you make less money until it goes. So the intuition is that it's not always going to go to this level, to this minimum level. You would like it you would like to have the informed trade hit before it gets to that minimum level. And so if people undercut by more than what was necessary to get to the front of the queue, they would be minimizing. So I guess you can think about it like, I just have to undercut by one tick to get to the front of the queue. And if I undercut by 2 ticks, I'm costing myself a penny on the transaction. If the trade arrives while my quote is the best trade. And so it doesn't make economic sense for me to undercut by anything other than the minimum amount.
Okay, so it sounds like in the model, there's maybe some exogenous friction that prevents, if I undercut, that prevents somebody else from undercutting me instantaneously after that.
It's not necessarily a friction. This is actually one thing I've thought about a little bit, and I'm like, I don't want to make the model too complex, but I think the intuition is I could endogenize I haven't done it in the current version, but I thought about going back and thinking like, well, what would if you endogenize the time between undercutting, if everybody undercut by the absolutely slowest or fastest amount, the price would instantly go to the minimum price, and it actually wouldn't really affect your likelihood of winning the run, because basically the likelihood of winning the run is just 1 over M. Like there are M sophisticated liquidity providers. You don't know which one's going to win. You're all undercutting. And so if everybody instantly went to it wouldn't increase your likelihood of winning the run, but it would decrease the profit that you earn. So all of the sophisticated liquidity providers have an incentive to kind of drag it out. And so they'll and if you think about it, and I think I could probably endogenize this, but it's at the sake of like, do I want to make the model too? The model's mostly for people who aren't microstructure people to understand the intuition, and because that's where we've run into trouble with this in the past. So I haven't decided yet whether or not I actually want to do that, but I think it would I think I could pretty straightforwardly endogenize tau as the parameter in the model and show that optimally you're gonna undercut by like some fraction of like the expected time is lambda, and so your undercutting time is going to be some derivative of that. And so you're not going to instantly undercut because that would be profit minimizing for everybody. Yashar?
So Josh, sorry, real quick. So Josh, would you think something like the fixed cost of getting into this undercutting game could be the friction that we could rely on to say, well, this is not going immediately to zero profit?
I'm not sure. I think with what Peter was saying just now, it sounded like maybe you have in mind some tacit collusion among these strategic liquidity providers. And they like tacitly collude to have these be, as Bjorn said earlier, walks as opposed to runs.
Yeah. No,
I guess that sort of, I think, resonates, but I'll take a closer look at the model in the paper.
And I think the other thing is like there's a literature on undercutting runs that we're tapping into for this, but it's not the primary focus of the paper. And so like for me, it's like empirically, these runs tend to take a few seconds. It's of a secondary importance to understand why they take a few seconds. It's more important to us to say they exist, this is how they happen. It will create this pattern in the data that we can capture with the quid variable. And so it seems like that's a very interesting question that has been kind of secondary to what we were trying to accomplish with this.
Okay. Thanks, guys.
All right. Thank you. Thanks, Josh. Bjorn?
Yeah, thanks, Peter. You have touched on upon this a little bit, but I'll ask anyway. I think both the model and your intuition here is set in a world with liquidity, market makers providing liquidity and traders consuming liquidity. But we know, of course, that the informed traders also like to use limit orders. Mm-hmm. And so does that imply that your measure will primarily capture informed trading based on short-lived information or aggressive informed trading?
That's a great question. I want to think about that. About that one. You know, Bjorn, can I think about that? And then like, I don't know that I have a super, because there's a lot of moving parts to try and I'm not smart enough to do that on the fly. Let me think about that, and I'll send you an email when I thought about it more carefully. I think that is a useful question in terms of thinking about like what types of information, because you're right. I think given the very low correlation between our measure and other informed trading measures, it seems like we're capturing something different. And so understanding what that difference is, I think, is a great is a good exercise.
So Bjorn, I think what you're saying is fair, that in the sense that what we are really building on is what market makers fear. And we believe the core thing that market makers fear is filling incoming marketable orders that are toxic. So, I mean, this is a probabilistic outcome. What we're saying is that there are times where this probability goes up, and then when it does, we can pick it up in the data, right? What type of information? I think you're probably right. It's going to be more short-lived than long-lived. But again, it is also from the perspective of the market makers. I mean, these market makers hold inventory for very short periods of time. So they probably don't care about what the alpha is going to be 2 weeks out, 1 month out. What they care about is the next 5 minutes, right? So as long as they feel there is going to be a big price drift in the next 5 minutes, they're going to get nervous and undercut less. What does it say about the longer term alpha? Like Peter said, I don't think we have a very good answer for that right now.
Yeah, I kind of expected an answer along those lines, that the informed traders choose whether to submit a market order or a limit order, and the focus of the market makers is to avoid the market order, the toxic market order. And
that's what we're building on. Yeah.
Yeah. Great. Thanks.
All right. Looks like we have run out of questions. Thanks, guys, very much, and good luck with the revision.
Thank you.
Justin, is there a question?
Yeah, just a general question, actually. Firstly, really interesting presentation. I work in options market making as a job, and I'm trying to build my own trading model in my spare time, and I'm just looking for more communities. Like, do you guys have any recommendations for places where I can go to meet people who are working on this kind of stuff?
So there is actually a derivatives online seminar series similar to this. If you write us an email to just do the general microstructure exchange email, we'll connect you with them.
Thanks a lot. I appreciate it.
Yeah, no worries. All right, I think I said good luck with the revision. If I haven't, good luck with the revision. Thanks again for everybody's time, and we are hoping to see you all back in 2 weeks when we will have Claudia Moyes, and that will be our last seminar for this spring.
Great.
And
And thank you,
please send
everybody,
us
for
your
your comments and contributing. There'll be a new version of the paper up in the next month or two.
Great. And don't forget to send the papers to the call for papers. All right. See you, everyone.